Today, my guest is Anthony Geraci. He's with Geraci Law, a law firm focused on working with real estate investors from the lender side of investing with banking and finance matters. But before we jump into our conversation with Anthony, I want to remind you, if you like the show, please let us know. We'd love to hear from you. You can do this. You can either like, you can share, or you can subscribe to CREPN Radio. Or if you go on your iTunes, it's under Commercial Real Estate Pro Network is the when you search for that. Also want to remind you that if you'd like to see how handsome our guests are, you can check out our YouTube channel. And that's again on YouTube at Commercial Real Estate Pro Network. With that, I would like to welcome my guest, Anthony Geraci, to CREPN Radio.
Thank you for having me. Appreciate being here.
Well, Anthony, we talked just a little bit before we started recording, and I'm excited to talk with you. And just to kind of set the stage here for the listeners here a little bit, how I was made aware of you. We share a mutual client, private money lender, and for those who don't know, I don't toot the horn too much, but again, just as reminders, I'm an insurance broker by day, and we have a product that works well with these private money lenders. And if that is anything that you do or interested in, I invite you to reach out to me and be happy to tell you how we can work with you there. But what caused me to reach out to Anthony was speaking with this client and asking them about more of the support, the back end, all of the critical elements to running a private money business. And so with that, I reached out to Anthony, and he's graciously agreed to join us today and share a little bit about himself, his firm, and get into this a little bit. So before we get going, Anthony, if you could share a little bit about your background and your firm.
Would love to. So Anthony Geraci, again, from Geraci Law Firm. We also run a media division as well as consulting division as well. I've been practicing in this area of my entire career, 14 years. We have 22 attorneys now, and we've grown from me in a 47 square foot office to a 10,000 square foot place, which is great. And been doing this my entire career. I think right now we represent almost 600 hard money lenders across the country in various stages, anywhere from what I would call mom and pop shops, just getting started, all the way up to billion-dollar hedge funds that focus primarily in the private money space, and really everybody in between. So we have a litigation division to defend people and any lawsuits borrowers bring against them. We have securities. We advise on private placements, on Reg A's, and all kinds of different securities placements, as well as corporate documentation. And then our largest department is transactional, which is basically compliance and pretty much anything regarding private money from the transactional side. We assist, we draft, we are basically the inside-outside counsel to our private lender clients. So we've been doing this quite a long time, and it's been quite the journey through Dodd-Frank and some of the other laws post-2007, for sure.
No, I'll bet last 14 years, you've certainly seen the up and down of cycles. And like you mentioned, the Dodd-Frank, what that's brought into, the whole finance equation. And so I'm guessing you've seen a lot, and probably even a lot of movement. I'm kind of curious if maybe you could talk a little bit about how the business changed
Sure.
from pre-crash to post-crash Dodd-Frank.
Yeah, and you can look at that at a lot of different angles. I'll focus kind of on two. If you remember back in 2005, that's when I really started cutting my teeth in this area. But even before that, it was really, you saw the genesis in 90s, late 90s, early 2000s of what I call the subprime shops. And the biggest people out there were Option One, New Century. All these players, they all had big credit lines from the banks, from Chase and who was a big player back then? I think Wells Fargo as well. And right around the 2003 to 2005, you started seeing these banks buy up these subprime companies. They were hungry for origination of these different products. And so I believe Wachovia was bought by Wells Fargo, who in turn was trying to buy a number of different lenders. I think they ended up buying Connecting Investors Exchange at one point back in the day. You had Option One and New Century just getting the huge credit lines from the top banks. So really, and what would happen with these, they would be securitized on Main Street, if you are, Wall Street. And people like you and I would buy these securities, right? So instead of think about that, of what we'll discuss later on today about how you buy notes, but really people were buying this all this time. They were just buying pools of mortgages backed by stock. And that's what the early 2000s were all about. That should pose a problem for our private money clients, because back then, private money was really focused not so much on fix and flip as it is today, but really focused on homes. And we had the sub 500 credit tier back then when people were getting loans. And the biggest product that I focused on back then was HELOCs, home equity lines of credit. They were huge. I had 3 different clients that really had built $200 million portfolios each just on second HELOCs. And of course, when the crash came, that's when a lot of challenges, a lot of problems came about, and had a lot of workarounds, and or some of my clients got wiped out as well. You may remember back in the 07 days, there was this mortgage implodometer, which it was crazy. Banks as well. When Lehman Brothers went out, they made the mortgage implodometer, and it was almost, if you can imagine, back in like the Wall Street crash was happening in one single day, over a period of weeks. I mean, clients I worked with, left and right, were getting added to this list daily. It was pretty crazy time back in 2006, 2007. Yeah.
Yeah, no, that was clearly, back kind of fog the mirror kind of lending requirements, 125% loan to value. I remember as being a standard. Yeah, I think that anybody that was, old enough to remember has probably some sort of a story they can remember of just how the landscape changed. Just felt like overnight. And I don't think everybody fully understood the ripple effect of it, how it was going to, totally decimate everything based on when you had these big banks fail that, there's plenty of stories. I think one of my favorites is, was it the big, say the Big Fix, but that's not it. What was that, Michael?
The Big Short.
Oh, the Big Short. Yeah. Yeah, I mean, just how eloquently he, was able to tell the story and the inner workings, and just how it was basically just casino kind of mentality there. But
sure.
No, and I think you mentioned Dodd-Frank. I'm kind of curious because in my mind that was kind of it may have seemed like it, or it may seem like an overreaching guideline now, but I think in hindsight, given how things were out of control, it seemed like it didn't seem totally irresponsible. But I'm kind of curious, how does that? Can you describe the pre-crash like you described, and then what the Dodd-Frank and going forward affected your client base?
For sure. And with that, I would just say the sheer length of time it took for, I would say, 90% of Dodd-Frank to be enacted. I mean, we're still seeing laws being enacted from a statute that was enacted 10 years ago.
Right.
And to give you a short, non-legal insight into that, Congress created the statute, but they left it to the CFPB, the Consumer Financial Protection Bureau, and a few others to actually implement the laws and make the laws for this statute. And it's taken 10 years, and we still don't see some of it. But rewind the clock back to 2008. So you saw all of this, and Congress decided that, well, the reason we had all these issues, is these errant mortgage brokers, which I personally disagree with, but that's what it was. So, all these mortgage brokers, there was no background check. Anybody could be a mortgage broker in these states. So the very first thing that was enacted was actually pre-Dodd-Frank. It was the SAFE Act in 2008. And what the SAFE Act was, it was supposed to almost, I would say, quasi-nationalize licensing for mortgage brokers. And I say quasi because states would still have complete authority as far as issuing different licenses. But there was this overlay. It was initially regulated by HUD, and then when the CFPB was created, CFPB took it over. And this overlay required mortgage brokers to pass a background check as well as a minimum what do they call it? Continuing education credits. And between those two was really the first insight we saw as far as Congress on a national basis trying to get some hold over the mortgage industry. And I think you saw part of that, again, going back to the Big Short, or if you want to go to AIG, when they had huge investments in subprime and really almost going bankrupt, Congress really felt they needed to act on these different things. So the SAFE Act was first, And then, of course, you had this big enactment of Dodd-Frank in 2010. That's where we got the creation of the Consumer Financial Protection Bureau and some of these other laws that started to take effect. You would have to fast forward, though, to 2014 in order to really see kind of the bigger picture, if you will. It was this law of 2010, 2014. CFPB would enact some. There was fights in Congress about who should be doing what. Long story short, even the Jobs Act took, I believe, 3 years to get enacted. You had a fight within the SEC saying, well, I don't believe in the statute, so I'm not going to issue any laws. You already had the commissioner of the SEC saying that. I'm not going to do anything about it. I'm going to sit right here. And when she was not elected again, the Jobs Act finally came to fruition in 2014. And that's where you saw a bigger ability on companies to raise money publicly, even using the private exemption. As it pertains into lending laws, though, you saw a lot of protections beefed up for consumers in the residential and owner-occupied, as well as an expansion of historically 2007 before. If it was just consumer purpose, owner-occupied, there were protections. But now this was expanded to any consumer purpose. Even if it was on a commercial building, you would have to have these same protections, disclosures likely. And that's what the Dodd-Frank Act really started complicating life, if you will, for my clients. As you think about it, they had a commercial building and really had to figure out what was his consumer purpose. If so, I need to give you disclosures.
Interesting. I hadn't looked at it from that standpoint, and I guess my introduction there about Dodd-Frank and just there was something that needed to be corrected, I guess I would say, from the problem we did, and I clearly I've experienced the pain numerous times here of the effects of the rule or the law, and just
for sure.
Now trying to get a loan for your single family residence is just crazy compared to what it used to be. And I think that there's always like one step forward, 3 steps back, or vice versa kind of thing. But I hadn't realized that was basically the sum of it, is that now was applied to the commercial side of things. So if you have is that commercial lending or a commercial
properties. So it's still consumer lending. So
okay.
Give you an example, you have this great industrial building, right? What's historically been commercial. There's no ifs, ands, or buts, it's commercial building. But you want to get a loan to buy your daughter a car. That's squarely within the consumer purpose realm, of which the lender would have to give you disclosures, and of course going through some of the other stuff as far as ability to repay and stuff like that.
Oh wow. Okay. Yeah. Okay. So interesting. I hadn't understood that. Mm-hmm. Okay. So let's talk now. So you were working with clients before the crash, the 10-year cycle of kind of actually the work through of the rules, or I don't know, it's a 10 years, but you mentioned until about 14 when the Jobs Act, is that fair to say that was kind of the switch that flipped for a lot of the go forward, and that a lot of the private lending?
For sure. Jobs Act, as well as a lot of the laws within Dodd-Frank, become clearer. Because what was happening in 2009 to 2014 is a lot of my clients threw their hands up. It's too complicated. We have no idea if we're going to be liable. There was just a whole gray area. Well, if I make this loan, literally these were the questions my clients would ask me. If I make this loan, do I comply? And I have to say, I don't know. I don't know what this rule is going to end up like. All we have is the law, which is so vague and ambiguous, it could fit almost any scenario. And the CFPB hadn't issued regs yet. They were slowly going through the period and issuing regs for different laws. And so my clients were like, well, I'm not going to get into that right now. What can I do? Enter the fix and flip market that I think most people are familiar with today. 90% of my clients do fix and flip loans.
Gotcha. So let's talk a little bit about your clients and kind of how you work with clients and what the makeup, or because I think the majority of the guests we've had on the show and the conversations we've tackled have been more about investing from a standpoint of an actual physical asset or through a syndication or something, but more about a property and the equity side of things as opposed to the debt side of things. So if describe to me what a client of yours would it be a fund or would it be an individual or and then how much money are we talking about to get started with for lending purposes that you deal with?
Sure. I would say all the above. If it touches private lending, our smallest client is an investor who has maybe $10,000 or $20,000 to lend. As I said, our largest client is a $1 billion hedge fund and everything in between. Because we're so focused on this niche, I'd like to think at least most people come to us when they touch this area. So, for us, we're agnostic as far as size. We, of course, offer different services depending on the size of the client. But, you could get them started in $10,000 or $20,000 very easily. And that's even in California, even though it doesn't sound like you can make a loan for $10,000 or $20,000 to someone. In California, we have fractionalized loans that a lot of my clients will do. So it does not have to be, $100,000, $200,000. And of course, $10,000 or $20,000, say on the East Coast, like Tennessee and some other states, is more than enough for a loan on a property.
Gotcha. So the smaller to the hedge fund, I mean, that's pretty good size range.
Mm-hmm.
So are these primarily people with what am I going to say? I guess money inside a retirement vehicle or money outside a retirement vehicle, or how? I mean, is it
Mixed?
Mixed?
Yeah.
Okay.
For sure. It could be a fund. So a fund is not going to be usually organized as a 401k investment, but they do take 401k investments in the fund. Or it could be if a single investor wants to invest, they'll generally invest in a 401k or at least a retirement investment. That way, no matter what the yield is, it'll be tax deferred or tax free, depending on, of course, the IRA vehicle. And then, but some people just don't care and they take it in their own name or they have a company specially built for this.
Gotcha. So in the scope of services that you guys provide, does that start with the entity formation and structure and the notes, or give me kind of an array of what you guys do on that?
Sure, and they're hand tailored depending on what the client is looking for and what they want to do in this space. So like for a traditional investor client, we can definitely create a company and we can advise them as far as, well, does this deal look good, right? We're pretty familiar with the space enough. We can look at the loan documents, we can look at the scenario, and generally speaking, they're probably one of our clients anyway. So we can give them that advice to the extent it doesn't conflict with our other clients. For our lending clients, I mean, we start usually with transactional. We draft their loan documents for them. We will look at their current loan documents and edit as we need to, and making sure that they fit. Or, again, for our larger clients, we're definitely, they touch all of our departments. We're doing securities offerings for them. We're doing their loan documents and transactional and general advice. And generally speaking, we're representing them in litigation. So, absolutely.
And speaking of the litigation, I would assume that the goal is to avoid litigation. So you whether you create a fund or you're an investor in a fund, the fund makes money by making loans, the repayment of the loans. And to that, I'm assuming that majority of these are hard money loans. Is that correct?
Correct. You got it.
So, and in that interest only, is that pretty much the standard, or?
It depends. Yeah, for most of our fix and flip, that is the standard. For our consumer purpose funds, because there are funds that focus still on post-Dodd-Frank, if you will, consumer owner occupied lending, they can't be interest only, so they have to be fully amortized.
Okay. And legal, what are some examples? Is it basically foreclosure kind of legal stuff, or I mean, can you give me kind of an array of?
Oh, sure. Yeah, mostly foreclosure. That's when everybody wants to sue because something happened, even though generally those are delay tactics. Some of our bigger lawsuits really comes down to sometimes we make a loan and there's a fight between the two parties that get the loan and they drag us into it. We're like, we don't really care. Look, you guys both got a loan, and that just takes time to unwind and what have you. I would say the vast majority are just, bad lawsuits, if you will. The other side is also, our client thinks they make a business purpose loan, which is exempt from Dodd-Frank and Truth in Lending Act. And the borrower is saying, well, no, this was a consumer purpose loan. And, really that's such a fact-based issue. So it takes a while to discern and also convince a judge, hey, this was a commercial purpose. This should not be covered by anything under Dodd-Frank.
So in that, when making the loan, it's up to the lender to determine or to, I mean, how is it basically, is there a questionnaire you go through to figure that out, or?
Sure. Yeah. So there's a lot of things. So under the Ninth Circuit, which is California, but under most of the circuits anyway, there's this predominance test, as in why did this borrower get the loan, right? And there's some safety nets, like 51% goes to a commercial purpose. So you want to document that. You know, what is the purpose? Well, I want to go invest in this company and I want to go run it. Very cool. So that's a commercial purpose, as long as you document it. And what we advise our clients is make sure you wire that money to the business account. Don't wire it to personal account. Wire, have escrow wire it to that business account if that's what the true proceeds are for. And that just goes to the argument, right? That's what I'm saying. A lot of it is fact intensive. You can definitely have questionnaires, and you definitely want them to certify that these are business purpose funds. And everything should add up to, hey, we thought all along this was a consumer purpose. If it wasn't, the borrower lied to us. Therefore, they should not be able to argue now that it's consumer purpose.
Right. Yeah. You have loan fraud in reverse there.
Right.
Yeah.
And that's, people forget that too, is there's such things as loan fraud. And, borrowers sue, and usually, at least in California, if it's above $150,000, then they lied to us. That's mortgage fraud. It's criminal as well as civil.
Gotcha.
Mm-hmm.
Question for you on some of this on the legal stuff. I think this is kind of my experience again from the insurance side of things. When legal the lawsuit gets, when everybody gets lawyered up and there's a lot of dollars at stake, is there any kind of a time frame that you, worst case scenario and these kind of things that you've kind of coach your clients on what to expect? Or?
Oh, absolutely. Yeah, I mean, give you an example. 6 months ago, I handled a case for a client, and I told them if they hire this firm, which I suspected they would, we're going to trial. And if they don't, then we can likely settle this. And of course, I hired the firm I thought they would, just because the other firm on the other side, they don't really know our area. And that's the other thing. You either specialize in this area or you don't. I guess that's probably like insurance too, right? You know when someone actually knows what they're talking about versus not. And this law firm, they're a big law firm, but they have no idea what they're doing in my space. And then it just comes down to educating them. And again, they're still so stubborn, they think they'll just outspend us to death. And basically said, well, we have this attorney's fees clause in the note, and we underwrote this pretty well. We'll just add it to the back of the note if we have to. And that's what, $200,000 later in attorney's fees. That's what we did. But definitely, we're always setting expectations for clients as much as we can. But I always, in our notes and most notes, any attorney's fees are generally added to the back of the note. So as long as the underwriting was sound and there's still plenty of equity in the property, literally the borrower is just costing themselves money.
Gotcha. So the entity formation, fundraising documents as well? You guys?
Sure, absolutely. Yeah, we do quite a few different securities offerings.
All right. And on the securities, is that governed by all SEC? I mean, when you're dealing with lending, is that?
It is nowadays. Yeah. And I mean, that is one benefit. Dodd-Frank gets a bad rap from the negative side of things. The real positive for my clients was the Dodd-Frank and SEC, because it allowed them to use the private placement offering to fully advertise. As long as they followed the rules within the Dodd-Frank, they could fully advertise under PPM laws. And that allowed us to stop working with the states. Not a negative thing, but most states, were difficult, as well as had approval, and their fees were expensive. So under the federal statute, we still have to work with the states, but it's more of we're coming to your state to raise money. This preempts any laws you have, and you have to follow these 3 steps, and only these 3 steps to determine whether we're allowed to raise money in your state or not. So it simplified a lot of things for our clients as well.
Yeah, I think that, or at least my kind of viewpoint of that is, it's amazing to me how much private money lending, or maybe this is just kind of my view on it. But I'd be curious. Do you feel like the private money lending business has exploded as far as the volume post Dodd-Frank, or not Dodd-Frank Jobs Act?
That's a great question. So we just started putting together a benchmarking survey. We did our first one last year, and so my hunch is yes, but I don't have any data to tell you. But I do have data to tell you right now that the estimated size of the industry is between $768 billion and $1.5 trillion.
Wow.
So, and we have a 10% margin for error, based on that, 10-point margin for error. But if you think about it, 10% of it's around, it could be as small as 600 million or as big as 1.7 billion. So still pretty, billion and trillion. Yeah, 1.7 trillion or 600 billion. Still large numbers in my mind that we're playing with, especially when a lot of people estimate this space to be about 100 billion. It's much, much larger.
Do you have any sense of how big it was before the crash? Is there
That's
any?
tough. If we exclude subprime, which we really should, because subprime was backed by Wall Street, I would hesitate to say, I would probably say it was around the 100 to 200 billion mark before. I mean, you've seen hard money truly expand in the last few years, especially in the fix and flip sides.
Sure.
What we saw is about 5 years ago, all these crowdfunding sites came in, and really taking the Jobs Act and advertising as if it's crowdfunding, even though it's using the same Jobs Act that most other people do. But you see these crowdfunders come in, advertise, hey, buy a piece of real estate, invest $5,000 or $10,000, and we'll manage the rest for you. That really attracted a lot of people and a lot of money to the space. Add that, so that's on the bottom side. On the top side, we've got all these people chasing for yield. I mean, think about it. I mean, now, of course, we're sitting on a 5% prime rate, but even 2 years ago, we're talking about 3.25%. And hard money, for instance, is getting 8 to 12%. Well, I'm going to arbitrage that all day, and I think a lot of other people will. So that's what we've seen, especially in California, mass contributions of capital, to where you see yield compression in a lot of states. What was 12% 3 years ago, you were lucky to get 7% interest on a first trust deed in California.
Yeah, no, I was going to say that's the dynamic of the marketplace. There is you have all the available funds seeking yield, which essentially suppresses the rate growth,
Yep.
supply and demand kind of thing. Which I'm kind of curious to see how that plays out here as the interest rates creep up.
Mm-hmm.
I think there's plenty, and again, I'm not an economist by any stretch of the imagination, but I would say that anything that we've known from a historical cycle may be subject to a challenge, just based on the new laws and the ability to raise private capital and stuff. So I'm kind of curious. Do you have any sense of things on that? I don't know.
I have the same disclaimer. I'm not an economist either, but I literally had the same conversation with my managers last week. And I was like, well, guys, let's break this down for a second. If we're saying that a first trust deed is 7% in California and Wall Street prime is at 5%, well, we've got 200 basis point difference. And that's going to be rapidly scaled up. I think no one's saying, okay, the Feds are going to stop raising interest rates. I think we can all agree, hey, they're going to keep on raising a quarter point, especially when GDP was 4.2% increased last quarter. There's no stopping this engine right now. So as that gets closer, as those numbers get closer and closer to where they become the same, which will happen in probably about 2 years, where's the capital going to go? Are you still going to lend, all things being equal, are you going to take that yield on private money, or are you going to reallocate it to some municipal bonds? And Wall Street's all about the safety of bonds and government stuff like that. I think we see a mass exodus of capital in a couple of years from at least the Wall Street players that have been here. And that's going to be troublesome for some of the bigger people relying on Wall Street capital in a couple of years. So we'll see some people go out of business, I think. But I don't think we'll see anything like 2007.
Yeah, no, I think there's always some give and take in the marketplace. And I think that, it's hard to, I guess, comprehend how severe the crash was. I mean, just when you put that to scale as opposed to normal cycles that are always happening, recessions and the coming out of the cycles and stuff. When you look at those historically, how small they were compared to how big the crash was. I mean, we've come a long ways back up just to get back up. And
For sure.
and I think our memory is of this great crash. The anticipation is it'll be another great crash, but I think that I would think that it starts to normalize as we go forward, that it won't be so dramatic there. But I guess we'll find
Absolutely.
out.
Yeah, and I think for my clients at least, I'll see more diversification. Like I was telling you, in our benchmarking survey, we found 90% of our lenders were doing fix and flip loans. I see that reducing in the next couple of years. And we'll see an increase in owner-occupied, now that Dodd-Frank's kind of settled down, and at least we can kind of predict where they're going and what they're looking at on the Dodd-Frank side as far as consumer loans. We can predict what they're going to care about as far as owner-occupied, what have you. We're going to see probably a lot more money come to the consumer purpose space again. And as you said, I mean, it's all cyclical at the end of the day. There was this huge blow up in consumer. That's, remember the HELOC days I was telling you about in 07. So that went away. And now we've been in rehab and fix and flip loans for the last 10 years. Now we'll see it come back to the consumer side. in the next couple of years.
Got it. Let me ask you on somebody's looking to get into the space. Is there any kind of an overall kind of things to look for, things to be aware of, whether it be they're wanting to start a fund, or they're looking for someone to invest with, or they're looking to make a loan? I mean, obviously, I would think that the first call they should consider speaking with you for some detailed input there. But I'm just kind of curious as a beware.
Absolutely. And I should say, full disclosure, we own this site, but we put together a site called Non-Conventional Lending Exchange. And it's free to use right now. And basically there's videos on there for people to learn about the space. There's a whole community of investors and brokers there talking about different loans and where they can ask questions and get feedback on. And of course, we have the exchange part itself where people can buy and sell loans. So that's a pretty good resource. And that's at www.nonconexchange.com. So hopefully they use it. But again, I want to be fully upfront. We do own that site, just FYI. Sure. Obviously, call us. Happy to give any advice. Some of the things to look out for is, as we turn in the next couple of years, what I'm seeing in the fix and flip market is higher LTVs. So loan to values are getting higher, yields are getting lower, and that just is a recipe for disaster as we start creeping up the next couple of years. Probably will be fine for the next year. So invest in short term would be my advice. If you're investing longer than a year, make sure you really focus on the LTV. I think people rely on appraisers too much and appraisals. Really take a look at that, and what do you think that value is going to be if you had to sell it within 30 days? It's going to be a lot lower than that appraisal. Because remember, at least in private money, value of the property is everything. Generally, borrowers aren't going to have deep assets and deep pockets to go after. So you're really relying on this asset to pay you back. So due diligence is paramount. Make sure you understand the whole story.
Gotcha. Now, and even with that, I'm reminded when I speak with investors from different states, just the ease of in and out, and depending on the state you're in and all that. You mentioned 30 days. I was like, I think that, and I know in Oregon, I think you might be tied up there for a while, but
yeah, absolutely.
Yeah. And then one other question I had for you: do you guys, as far as somebody that's looking to get into the lending and stuff, and maybe they've done some one-off kind of loans kind of thing. And this is something I guess I'm not surprised by, but I guess when I started looking around and realizing how many people are making these private loans out there, and maybe it was a handshake, or maybe they had something drawn up, but just all of the potential disasters, when all of a sudden you find out you're not getting paid, the house isn't selling, you've got a partially finished house, you've got your money tied up in this thing, the market's declining, the interest rates are going, the list can go on pretty fast. Do you guys work with people, or when you are helping them set up these things, is it more often to scale? Do you have a lot of people that come to you that are like a one-off and they're looking to scale and they want to have all the systems in place? Is that kind of where you guys can really, give them some direction? Or
I think that's our sweet spot for sure. We can help out anybody anywhere, right? But if you had to say, well, what's our skill set? We're really good because we have such a deep understanding of the space that we can translate that knowledge to people entering the space and saying, here's some of the things you have to watch out for. And again, something as simple as, we can even advise on product type, because if you want to enter the fix and flip market at this stage, I would really advise looking at something else with less competition, because it's so established and so oversaturated as it is, not the best business model right now. So we can help on advising on strategy as well as really helping them scale versus, we have a consulting division that can help them raise capital, as well as our media division that does marketing services. So that to scale is definitely one of our sweet spots. But again, we're such experts in the space, we'll help out anybody doing anything in this space. That's our passion.
Got it. Anthony, if we were to sum up today's conversation, if there was one thing that you would want the listeners to take from today's podcast, what would it be?
Private lending is a great way to make money. There are definitely pitfalls, and like any other business along the way, get knowledgeable and up to speed, get core advice from attorneys, accountants, and other professional advisors. but it's also a great way to own assets as well as collect assets along the way. I personally have done it for 10 years and been quite happy with the results. So
That's great. Anthony, where can the listeners go if they'd like to learn more or connect with you?
yeah, so I'll give you my email address. It's Anthony, Anthony, at GeraciLLP.com, and Geraci spelled Geraci. They can also go to our website, which is GeraciLLP.com. Or again, the non-conventional lending exchange we're part of too. So that would be www.nonconexchange.com. Any of those places I think are a great place for them to learn, grow, and again, we're here to help them every step of the way.
Got it. Well, Anthony, I want to say thanks again for taking the time. I've enjoyed it and I've learned a lot, and I hope we can do it again soon.
I look forward to it, and thanks for having me. This has been great. Happy to do it again.
Great. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.